Nobody knows what the future of AI really looks like, but no matter which way it goes, it seems like we've put ourselves in a position where if AI fails, the economy collapses. And if AI succeeds, it's only because it took all our jobs. Whether we like it or not, our immediate economic future is riding on the success or failure of this technology. Just the top companies are on track to spend $400 billion on data center buildouts this year alone. 400 billion. For comparison, the combined stimulus and bailout spending after the 2008 financial crisis was about $475 billion. So we're making a bet almost that large on artificial intelligence. And the entire stock market has clearly been buoyed by investor hype around what this technology could do at some undetermined point in the future. Now, that has done two things in the short term. Trillions of dollars worth of data centers may or may not turn out to be a spectacular waste of money. But at least for now, they're providing tens of thousands of high-paying jobs to engineers, tradesmen, and technicians all across the country. The same goes for the stock market. These impressive gains may or may not be backed by sustainable fundamentals. But at least for now, people who have seen their portfolios double in value over the last few years are feeling pretty good about treating themselves to a bit of conspicuous consumption, helping to keep the rest of the economy afloat. So let's talk about how AI is actually keeping the economy alive right now. When people think about AI, they imagine chatbots or humanoid robots, but the economy doesn't care about any of that. What the economy cares about is concrete, steel, electricity, and construction. A single large AI data center can cost between $1 and $2 billion to build. These facilities require tens of thousands of tons of steel, power consumption equivalent to a small city, and miles of cables, transformers, and cooling systems. According to the Bureau of Labor Statistics, construction jobs, specifically specialized non-residential construction, have been one of the standout categories keeping employment numbers from looking much worse. And the BLS explicitly highlighted data center projects as a major driver of this growth. The total employment up and down the supply chain for these buildouts is very hard to precisely calculate, but it's in the hundreds of thousands according to most industry estimates. That money is flowing directly into construction jobs, electrical infrastructure, contractors, and suppliers. But here's the catch. A data center is built once. After that, it runs with a few dozen technicians. A skeleton crew. So what we're seeing right now isn't a long-term prosperity engine. It's temporary economic life support. And eventually, this will be a problem, because theoretically, we're going to slow down on building these data centers at some point. A lot of this construction is also taking place in remote rural areas. That's very stimulating to the local economy for the 2 years it takes to get these facilities online. But if it slows down nationwide, it could have broader employment impacts beyond just the workers directly in the supply chain. The second pillar holding up the economy is the stock market. A lot of retirees and independently wealthy households have seen their investment portfolios almost double over just the last 5 years, which means they've been a lot happier to spend conspicuously. This is what economists call the wealth effect. Let me make it simple. A lot of people living off their investments have a set drawdown rate of about 3 to 4% for their everyday spending. You might have heard about the 4% rule for early retirement. This rule prescribes that you don't spend more than 4% of the value of your invested assets every year so that you don't eat into your principal wealth. Now, if your portfolio doubles in value over 5 years, that means you can do twice as much spending without changing your 4% rule. Before, $1 million, you spend $40,000 a year. Now, $2 million, you spend $80,000 a year. Same person, same productivity, double the consumption. That spending keeps luxury markets alive, service jobs afloat, the broader economy moving. This spending may be very uneven, but in theory at least, someone renovating their vacation home or buying a fifth sports car is giving money to contractors or a commission to a car salesman. But here's the problem. This money is not based on value already created. It's based on expected future AI profits. According to data from Bloomberg and Renaissance Macro, company spending on AI is now contributing more to GDP growth than consumer spending. In other words, we're spending money today that only exists if AI delivers tomorrow. That's dumb money behavior. Now, AI optimists love one argument: productivity will explode. And they're not wrong about productivity increasing. But let's look at history. Worker productivity has already increased by a lot for a number of reasons, including technology. But for at least 50 years, almost none of that increase has resulted in higher compensation for regular workers. Since the 1970s in the US, worker productivity has increased by over 60%, but real wages have barely moved. So more value was created, but it didn't flow to workers. Now ask yourself, why would AI suddenly reverse a 50-year trend? Businesses got access to a greater supply of labor than they demanded, and without any negotiating power that pushed labor prices down. AI is really just another technology that will mean businesses demand fewer employees to perform the same operations, and it's something that reduces negotiating power as well. If a company can do the same work with 30% fewer employees, replace labor with software, where does the saved money go? History gives us a very clear answer: shareholders, executives, the top, not downward. Since 2023, more than 150,000 job losses have been directly attributed to AI, according to Challenger Gray and Christmas, a firm that tracks layoff announcements. This year, outside of federal worker layoffs, the number one reason cited for layoffs was a cost-cutting shift towards AI. Now, I know what you're thinking. Yes, a lot of companies are just claiming they're doing layoffs because of AI, when really they just want an investor-friendly way of saying they're cutting costs. But that's actually exactly the point. Even without the ultra-optimistic tools that could be made possible by this technology, it's already becoming a great negotiating tool against workers, pushing the gap further apart rather than closing it. For companies, AI means we don't need as many people. For workers, AI means your job is negotiable. Even before full automation, AI is already weakening labor's bargaining power, and that alone shifts money upward. Now, let's look at the downside. $400 billion in capital expenditure this year alone is a pretty big economic stimulus. If AI fails to generate expected profits or development slows down, then what happens? That $400 billion annual spending drops. Construction slows, stock prices fall, the wealth effect reverses, which means jobs, investment, and consumption all fall together. If these values are reconsidered in a major way, then both infrastructure spending and investment-fueled household spending would fall simultaneously, seriously hurting employment. That's what makes this bubble different. We've always wanted the green line to go up, but never before has so much real employment depended on it. The economy is heavily concentrated around one single narrative. If that narrative cracks, everything feels it. So let's summarize. If AI succeeds, companies win, productivity increases, but jobs disappear and wages stay flat. If AI fails, the bubble bursts, construction stops, the stock market crashes, and jobs disappear. Either way, risk stays at the bottom, rewards stay at the top. It's a lot of techno-economic jargon to try and gloss over what you probably already know, which is that if the people that own these tools can make a lot of money off not needing to pay workers anymore, they're going to try their very best to do it. So the real question isn't whether AI is good or bad. The real question is, who's insured in this bet and who isn't? And as always, dumb money finds out last.